Learning Objective 6-3, prepare equity method journal entries and consolidation entries for the consolidation of a subsidiary following downstream inventory transfers. So under the fully adjusted equity method, what we want to be able to do is you want to have the parent record all the little adjustments to income of the subsidiary or the parent so that the parent's net income on their books is going to be equal to consolidated net income. So if there's parent records gross profit on a sale to a sub and that gross profit needs to be deferred, then we're going to defer that gross profit so that the parent's net income still matches what consolidated net income should be. Now, you don't have to use the fully adjusted equity method. You could use the cost method or the market value method, as we call it now, or you could use what's called the unadjusted equity method, where you don't record these transactions. The benefit of using the fully adjusted equity method is by using this method, the parent will always be able to calculate consolidated net income on its own books, and it doesn't have to go through the whole consolidation worksheet in order to do that. And that'll be helpful to managers. You don't want managers to have a surprise when they do the consolidation worksheet and suddenly discover that they have less income than they anticipated. So we want to record all these little adjustments on the books of the parent, and if the parent recorded additional gross profit, then we want to defer that additional gross profit until until it's actually realized, i.e. when the goods are sold to an outside party. So that's one piece of it. Furthermore, we're going to need to eliminate this gain when we do the consolidation. So if we have a scenario, a very simple scenario, where the parent buys the goods for $250, sells them to the sub for $400, and then the sub sells the goods to the outside to $500, then this middle transaction here between the parent and the sub has no substance and needs to be eliminated. So the parent recorded sales and cost of goods sold. We didn't sell it twice, right? If we don't do this, then you have $900 in sales and you sold the same thing twice. So what we're going to do is we're going to debit sales of $400. We're also going to debit the cost of goods sold recorded by the sub. When the sub recorded the sale, they recorded cost of goods sold for $400. We're going to eliminate that too and debit cost of goods sold for $400. But the more complicated scenario is going to be right here. Let's say that the parent buys the goods for $250 and sells them to the sub, and the goods are still sitting on the books of the sub. In that case, the parent recorded a $400 sale that's no good. The parent also recorded cost of goods sold that's no good. So what do we do? So I recorded the journal entries right here to show you as an example. And you can see here that the parent would record debit cash credit sales for the amount of whatever the parent sold to the sub for. And the parent would also record cost of goods sold and inventory, assuming they're using a perpetual inventory system. So that would mean the parent is recording a $150 gain, and that gain has not yet been realized because the parent is selling to an affiliated party, and it's not gross profit according to GAAP. So we're going to have to hold that gain until the sub actually sells to the outside. So there's two pieces of this. On the books of the parent is going to need to eliminate this. It's going to need to remove this gain. And again, the parent is not going to debit sales, credit cost of goods sold, and credit the investment account. They're actually going to debit income from subsidiary and credit investment in subsidiary. This way, the gain is stored away on the books with a subsidiary where the gain is sitting on the subsidiary's books. And when you do your consolidation worksheet, we're still going to have, the parent is still going to have a gain of the sale of $400 and cost of goods sold of $250 sitting on their books. So we're going to eliminate that by debiting sales for $400 and crediting cost of goods sold for $250, and the difference gets credited to inventory by $150. Why inventory, you ask? Because when the sub bought the goods, the sub debited inventory and credited cash for $400. That purchase by the affiliate would look like this: debit inventory for $400 and credit, let's say, cash for $400. So right now the inventory is sitting on the books of the sub for $400, whereas it really only cost $250. So we're going to need to write the inventory back down from 400 to 250, and that would be by crediting inventory in the consolidation worksheet for $150. And again, I'll just note here that whenever I try not to present journal entries that would appear on the consolidation worksheet, the book does, and I just don't want you to be confused that this here goes on the consolidation worksheet and it doesn't go on any books. So typical things to look for here would be inventory transferred from a parent to a sub or transferred from a sub to a parent. And part of the inventory might be sold to an outsider, but part of it might remain on the buyer's books, in which case that sale would need to be split into two parts. And part of it you can record the gross profit on, the portion that was sold to the outside, but any inventory that hasn't yet been sold to the outside needs to be written down. Just a little note, again, I like to stick to the book. And if you look at this carefully, you'll notice that I did some extra journal entries. I just thought for clarity, it's easier to explain it if I show you a few extra items that I think the book neglects to mention. So please don't be put off by this. I'm just giving you a little extra information that I think make this clearer. Here's the story. Peerless owns 80% of Special. Big surprise. Peerless buys inventory costing $7,000, sells the inventory to Special for $10,000, and next year Special will sell it to a non-affiliate for $15,000. So that's this example where you sell it to the next year. And again, if the Special sold it this year, then all you would need to eliminate is the transaction between the two parties. But this is going to be the more complicated example. Special sells to the non-affiliate for $15,000 on January 2nd, 2022. And then, but that's next year. This year, Special Foods net income is $50,000, and Special Foods pays a total dividend of $30,000. So the first thing that happened was Peerless bought the goods. So Peerless will debit inventory for the amount that it paid, $7,000, and credit cash for $7,000. Then Peerless sells the inventories to Special Foods for $10,000, debit cash, credit sales for $10,000, and then Peerless also records cost of goods sold for whatever it costs, in this case $7,000, and credit inventory for $7,000. That would be a perpetual inventory entry. Special Foods is buying the goods, so Special Goods would debit inventory for whatever it paid, and this is where the problems begin. It paid $10,000, which is not the cost. So now it should bother you, right? The inventory is on the books of Special for $10,000, even though they only cost $7,000. And that should, bother you if you're a really dedicated accountant. It's something that you should think about at night. Like at night, you're like, oh yeah, this is $3,000 unrealized gain sitting on Special Foods books. I have to remember to eliminate that. So now year end comes, and Peerless records its share of income in Special, so debit investment in Special Foods for $50,000 times 80%, or $40,000, and credit income from Special Foods for $40,000. And then Peerless also receives a dividend of, remember when we first did this, it seemed so difficult, 30,000 times 80%, or 24,000, and credit investment in Special Foods for 24,000. And now there's one more piece to this. This is where Peerless is going to eliminate the gain. So what Peerless is going to do is, rather than eliminate this whole entry here, because what in theory, the Peerless should really do is should debit sales for 10,000, credit cost of goods sold for 7,000, and credit investment in Peerless for 3,000 because that's where this gain is. Rather, what Peerless is going to do, because this way Peerless will know where this unrealized gain is. It's sitting in, having this journal entry just sitting on the books is going to remind Peerless that it has this $3,000 unrealized gain. And Peerless will debit income from special foods and credit investment in special foods for $3,000. This will write down the investment for the unrealized gain. It will eliminate the income, and this way Peerless's net income on its own books will be equal to consolidated net income under the fully adjusted equity method. The next thing that we do now is we do our basic elimination entry. So the basic elimination entry is going to involve debiting income from special foods for whatever that value is, in this case $37,000. Now I should note that the book takes a little left turn here in chapter 6, and previously this $50,000, it actually made the left turn in chapter 5. This 37, they used to do 50,000 and split it 2 ways. Now they're just taking income from special foods and eliminating it directly. And that's just something to be aware of. We'll see later on the outcome of doing it this way. The non-controlling interest will be 50,000 times 20% as it was before. So the net income to the non-controlling interest is still $10,000. Beginning retained earnings would be $100,000 debited. Credit dividends for $30,000. And I think I got and debit common stock for $200. And the difference between all of these is going to go to the investment account. So that would be 37,000 plus 10,000 plus 100,000 minus 30,000 plus 200,000 would be a credit to the investment account of $317,000. Excuse me, it would be 80% of this because we have a non-controlling interest. $253,600. And that's where things changed from the previous chapter. It's not going to be $253,600. It's going to be just $253,000. In the non-controlling interest here is going to be the plug. That would be 37, and this is why this chapter does it slightly different from the other chapters. The non-controlling interest is going to be the plug here. So previously, they calculated income from special foods in 2 parts, and then 80% went to the investment account, and 20% went into the non-controlling interest. In this chapter, you're going to completely eliminate the investment account, and then the difference is going to go to the non-controlling interest. And it can be done the other way also. It's just a loophole. It's a quirk in how this book does it. But that's not it. There's also going to be the optional accumulated depreciation entry, which is just $300,000. And I need to eliminate this gain. The way I'm going to eliminate the gain is by debiting sales for the full amount of the sale, $10,000, crediting cost of goods sold for whatever the parent recorded, $7,000, and the difference between these of $3,000 is going to go to inventory. Now the book gives you a roll forward technique to get around the problem I just showed you, and if you like, you can use that technique. That might be easier for you to do. I show it the way that I show it because I just think it's simpler for this purpose rather than having to learn this whole other method that the book goes into. But what's most important is this elimination entry here. Debit sales for the amount of the intercompany sale, credit cost of goods sold for the original cost, and the difference gets credited to inventory so that the inventory will be written down by $3,000. Now I'm going to add up the consolidated column off. So here you can see that your net income consolidated equals net income of the parent because you're using the fully adjusted equity method. Ending retained earnings is the same as the parent again. If you didn't use the fully adjusted equity method, if we didn't do it this way, then you would not have this. And again, you could use it another way, but it's nice to know what your consolidated net income is, and it's also nice to know what ending retained earnings is simply by looking on the books of the parent. And assets equals total liabilities. If you add up debits and credits on the balance sheet, they should be equal. There you go.